In Chapter 6, we're going to discuss business formations, choosing a form that fits. And I haven't mentioned this before, but I saw something that gave me the idea that these are the learning objectives for the chapter. If you want to, you can do this for each section. Try to answer these. Describe the characteristics of the 4 basic forms of business partnership. So as we cover section 1, you could answer that question. So the big 4. What are the big 4 business ownership options? So your choices are, your first one that we're going to discuss is sole proprietorship. And what that means is it's a single owner, only one owner, and that owner manages the company. So any income made or any earnings made from the business is put or recorded as the owner's income. And any debts that the business owes is the owner's debt. One of the disadvantages of a sole proprietorship is unlimited liability. So if something happens and the sole proprietorship or partnership, if the business can't pay the bills, then the owner's personal assets, such as cash, bank accounts, homes, they can be taken to pay the business debts. So they have unlimited liability. They can be personally held responsible for any debts of the business.
So a partnership is an agreement with 2 or more people, and they act as co-owners of the business.
A general partnership is a partnership in which all the partners take an active role in managing the business. So they all have unlimited liability, like we discussed in the previous slide. Then you have corporations. And this is where the business itself is considered a legal entity that is separate from the owners of the business. And with the corporation, you have the articles of incorporation. These articles of incorporation are filed with the state government. An advantage of a corporation is the owners have limited liability. So they cannot, debt collectors cannot go after the personal assets of the business of the owners. So they're protected. Their personal assets are protected. They can only come after the assets of the corporation. An LLC is a limited liability company, and it offers both limited liability to its owners and flexible tax treatment. This is relatively new, but if you're an owner of an LLC, you can either be taxed as a corporation, which is double taxed, or as a partnership. With a corporation, the corporation itself is taxed, and then if any dividends are sent to stockholders, those stockholders pay taxes on the dividends. So with a corporation, there is double taxation. So the most common type of ownership is a sole proprietorship, about 70%, 72.4%. But they only account for a little bit of 4% of revenue and 10% of profit. You can see here how much corporations, their profit, 6.33 million. Now we're going to talk about the advantages and disadvantages of sole proprietorships. Sole proprietorships are easy to form, and you can maintain control because you're the sole owner. Pride of ownership because it's yours. The profits stay with the proprietorship because the owner can keep those profits. And a possible tax advantage. And here are some of the disadvantages. So for limited financial resources, banks are kind of skeptical when lending to single owner proprietorships. The debts of the business are treated as the owner's personal debt. So unlimited liability means that if the proprietorship cannot pay the debt, that the bank or the debt collectors can come after the owner's personal assets. So they could take their home, they could take their vehicles, anything that they own to help pay for that debt. Limited ability to attract and maintain talented employees. Sometimes paying salaries is difficult when you're a proprietorship to try to keep good employees and pay them enough salaries. Then heavy workload. If you're the sole owner of the business, you're going to work longer and you're going to have a lot of stress. It's not easy owning your own business. Lack of permanence. So if the owner just dies or retires or decides that they don't want the business anymore, then the business ceases to exist. Okay, so now we're going to talk about partnerships. So can two heads or two bankrolls be better than one? So the formation of a general partnership, there's no limit on the number of partners. You should have a partnership agreement, and it will tell the initial financial contributions, the duties and responsibilities, how they're going to share profits and losses. Let's say we have 5 partners and they're going to share it equally, so it may say 20% for each one for profits and losses. What is going to be the process for settling disagreements? And what happens if the partner dies or withdraws? All this should be in the partnership agreement. So here are some advantages and disadvantages to a partnership. Well, one advantage is the more people you have, the more financial resources you can pull together. There is also the ability to share those responsibilities instead of just having it all, the pressure all on one owner. Like in a proprietorship, you're able to share with your partners. They're easy to form. Taxation is going to be distributed between the owners, much like the proprietorship, except you're going to have more to share the gains and losses with. The disadvantages is there is unlimited liability, just like with the proprietorship. They can come after the personal assets. Also, if you have more than one person, there could be disagreements. With these disagreements, a partner may decide to withdraw. So if that partner decides to withdraw, that could threaten the continuity of the partnership. It's not easy to withdraw, though. A partner who withdraws may be held responsible for those debts of that business during the partner's withdrawal. Limited partnerships are partnerships that's made up of at least one general partner and one limited partner. So the general partner will actively manage the company, while the limited partner is going to give up their role to manage the company in exchange for limited liability. So with a limited partnership, a debt collector could not come after the personal assets of the limited partner. Limited liability partnerships, all partners have the right to participate in management, and all partners will have limited liability for the company's debt. And I wanted to mention here that different states offer different liability protections. So the LLP in different states, they may limit what type of businesses can form as an LLP. Next, we're going to be talking about corporations and the advantages and disadvantages of being an artificial person, because a corporation is a separate person or separate business entity from the owners. The most common type of corporation is a C corporation, and it offers limited liability to all the owners, and the owners are called stockholders. A business that wants to become a corporation has to file articles of incorporation and pay filing fees, and also adopt corporate bylaws. Corporate bylaws are the basic rules governing how a corporation is organized and how it conducts its business. The requirements of this vary state by state, and some states are well known for having simple forms and what we call corporate friendly law and court systems. 66% of firms listed in the Fortune 500 are incorporated in Delaware. So Delaware is known to be corporation friendly. Ownership of a C corporation is represented by shares of stock, and these are just simply pieces of paper that tell how much ownership a person has in a corporation and if they can vote or make decisions. Stock for large corporations are usually publicly traded, and small businesses can have as few as one shareholder. Now, in accounting, we talk about common stock, and this is the basic ownership interest in a corporation. But some firms will issue common stock and preferred stock. So the stockholder is the owner, and the owner's amount of ownership is determined by how much stock they have. Now, an institutional investor is an organization that pulls together to buy stock of other companies. Since you can have so many stockholders, it would be hard to get involved in running the company. So corporations are governed by board of directors, and these are individuals that are elected by the stockholders of a corporation. And the board of directors should represent the best interest of the stockholders. The board of directors establishes the corporation's missions and objectives. The board is rarely involved in the company's day-to-day operations. The board of directors also appoints the CEO and the CFO to manage the day-to-day operation. Here are some advantages of a C corporation. C corporations have limited liability. Stockholders are not personally liable for the debts of the company. Permanence. Corporations can continue as long as they have the financial means to do so, and the stockholders want it to function. It can continue. Ease of transfer of ownership. If owners want out, they can sell their shares and withdraw from ownership. Ability to raise financial capital. If corporations need financial capital, they can issue shares, or they can sell former IOUs called corporate bonds to raise money. The ability to make use of specialized management. Corporations usually attract skilled employees because they can afford to pay these employees the right salaries. The disadvantages of corporations
are the extensive cost to form and operate and the complexity of it all. Complications when operating in multiple states.
Double taxation, meaning that the corporation is taxed on earnings, and then if they distribute dividends, the stockholders will also pay taxes on that. Lots of paperwork, they're regulated, and of course, publicly traded corporations have to show their financial statements, and there could be possible conflicts of interest. This seems to happen a lot. The management team or the board of directors, they're not on the same page. And the CEO may have a set of objectives and the board of directors may have another. And so there could be some conflicts of interest there.